The Pro Show is brought to you by Rockin' Media and our proprietary Flash HDR photo process, providing you with the best, most realistic photos of your property. See the difference at rockinmedia.com. Hi, and welcome to the Pro Show. I'm Rick Machle. On today's show, we are talking all about unconventional ways of getting a mortgage, whether you're self-employed looking for your own home or whether you're looking for an investment property. How do you get those done? And especially if you're self-employed and you have an investment, want to get an investment property, sometimes that can be complex. So we're talking strategies. That's next on The Pro Show. It's time to talk mortgages again. We are really thankful to have Kristen Buono and Nancy Alexander with us again today. Hi, Kristen. How are you?
I'm doing great, Rick. How are you?
I'm doing great. Kristen is from KB Real Estate and Lending. She's out of California. And we also have Nancy Alexander from Smart Mortgage Services. Hi, Nancy.
Hi, Rick. Hi, Kristen. Good to see you both.
Yeah, it's great having you both on again. We are looking at people who may not have a regular income or are looking for some real creative, and I hate to use that term because that was used like 15 years ago and got us in trouble, but looking at ways of having mortgages that will fund when you may not have a regular income or if you're actually looking for a regular income from them. Is that what we're talking about today, ladies?
Yeah, I think so. As Kristen put it nicely,
Okay.
Unique circumstances.
Yes.
Unique strategies to
Unique
build
strategies.
estate wealth.
So,
Better. There
so
you go.
you know, even if you have a W-2 and are a W-2 employee, you may have some ideas come out of this episode because there may be either transitions in your life to a different phase, or you're looking for rental property and how do you get into that. So let's start with, I'm not a W-2 employee, I'm self-employed, which I am. How do I qualify for a mortgage? What do I need? And who wants to start out? Nancy, do you want to start, or Kristen?
I'll get started with this bank statement loan because it's really extraordinary and we should have been doing it for a long time, but it's as simple as this. Take 12 months or 24 months of bank statements. Look at your business bank statements, and it's nothing more than deposits. Pull off 12 or 24 months of statements, look at your deposit stream, make sure the deposits that you're counting are the ones that go into the business. In other words, if you're a restaurant owner and you have DoorDash deposits, that would make sense, right? If you're a laundromat owner and you have DoorDash deposits, couldn't count them, right? So we count your deposits, we add them up either 12 months or 24 months. The reason there is a difference between the two is because there's a difference in pricing. And remember, when Kristen and I speak of pricing, we're speaking of interest rate, right? So 12 months, your interest rate is a little bit higher. 24 months, it's got a little bit of a decline to it. So again, we're going to add up all the deposits. We're going to either divide by 12 or we're going to divide by 24, depending on which program you're doing. That then becomes your income stream.
And it's now you're talking about the deposit. Sorry to interrupt. You're talking deposits for the business, or you're talking about personal deposits?
You know, that's a good question because you can use one or the other, but you can't intertwine them. You can't bring the two together and say, okay, these 3 bank statements are personal, these 4 are business. So choose your avenue, right, as to whether you're going to use your personal or whether you're going to use your business. Most use business account, and personal then does not come into it. And remember, the reason you're doing this is because you're not showing income on your tax returns, Rick.
Okay.
So if you're self-employed and you're not taking deductions or very few deductions and you're showing all of your income, then fine, go with your tax returns. But if you're not, then look at bank statements or know that there is bank statement loans out there that you can do. Really, every investor has them at this point. They're becoming quite commonplace. Because, of course, the self-employed individual, what they want to do is take as many deductions as what they can. That's the way the IRS is set up. right? Is to take those deductions and reduce that income. It works beautifully when you're filing your taxes, but not so beautifully when you're going for a mortgage loan. Because again, we want that income stream. It's the one indicator to the lender as to how what is your ability to pay back the mortgage or the loan that you're being given, is that income stream.
So
They'll
you're
also look to, I'm sorry, just to jump in real quick. They're going to look also, it's not, I mean, yes, it's the bank statements, but going back to the ability to repay, they will still, lenders are still going to want to see, certain credit scores. They're going to want to see time. How long have you owned the business? How long have you had the business? Just a couple different factors like that, because as Nancy and I spoke the last few episodes, Rick, it comes down to strategy. It's always about like, what's the play? What's the strategy? And it doesn't matter who the buyer is or what your situation is. We want to analyze that strategy and figure out some of the strategies are more unique than others, but this is a great tool to get that self-employed borrower to a position of real estate, building real estate wealth.
Beautifully said. Yeah.
So what you're looking for is that, yes, I have money coming in, going out, and for tax purposes, as Nancy said, you're trying to reduce your income. You're trying to not look like you have any income, but really you do have lots of cash flow. You're just choosing where to put that cash flow, and if part of that gets then allocated to a mortgage, whether that's for investments or other things, then that can be looked at as long as it's consistent and relates, as Nancy said, to the business that you run. Rocket Media doing DoorDash doesn't make sense in Nancy's scenario, correct? But Kristen, does this impact your rate because you're a higher risk, because you're not, or how does that work?
Typically, there's so many different factors. So on on the purchase, they're going to look at, loan to value. They're going to look at credit score. They're going to look at, going back to, what's the rate? What's the rate? What's the rate? Well, the question Nancy and I like to say is, what's the strategy? What's the strategy? Yes, you'll take a hit in the rate because technically, since it is considered a non-qualifying mortgage, a non-Fannie Mae product, then you will, I hate to say pay to play, but you will pay to play a little bit in taking a slightly higher risk, slightly higher rate.
What's that difference though, Kristen? If we're really talking, 7.5 compared to 6.75?
Yeah, again, depending on credit score, down payment,
20% down versus 20% down.
Exactly. Yes, exactly. Yeah. So it's not horrible. I mean, like I said, depending on the person's goals and where they're at and how long they're going to hold the property, and maybe they'll do the bank statement program, get in the property, and then maybe have 2 years of reported income, and we refi it in 2 years. I don't. Every situation is going to be a little different.
Now, are these, is this a situation where we're talking about like an investment property or your primary residence, or both?
I would go primary residence on the bank statement loan.
Yeah.
Okay.
Second home before I would go investment property. And you'll find it in investment property, but you're really gonna take a hit in rate.
Yes.
Okay.
Now on that investment property, I think Kristen's got a much better strategy going into the next kind of out of box non-QM, right?
Yeah.
And go for a minute before we go to your next one as to what is QM versus non-QM.
Yeah. So I threw that out there. So basically you've got Fannie Mae and Freddie Mac guidelines, and those are going to be what I call your traditional mortgages, because they're going to, the investors are going to sell those on the secondary market.
So QM is qualified mortgage.
Correct.
Okay.
QM, qualified mortgage. Yes.
Okay.
Non-QM, non-qualifying mortgage.
So it doesn't fit Fannie and Freddie guides.
It doesn't fit the guidelines, and those are the unique situations that we have alternatives for.
And so if you've got those different alternatives, that then gives you the ability to get that mortgage, but it just takes a little more paperwork. So maybe we can go through, you talked a little bit about bank statements, so you're going to want to look at those, right? So that would be the business deposits, correct? And then you also then have invoicing or receipts, or is that the same?
No, because you're talking income stream versus assets.
Okay.
And so what you're building in the bank statement loan is you're building an income stream for the investor, for the lender, to see that you have the ability to repay the loan. You may not show the ability in your tax returns, so you're showing them then in your bank statements. And that's really all a bank statement loan is. Like Kristen said, do you have to be in the business minimum 2 years? Yes, you have to prove that. How do you prove that if you're not looking at income tax? Well, we go to Secretary of State, believe it or not. And we'll go to Secretary of State website and whatever state you're in to see how long the business has been registered with Secretary of State. And so that will give us proof. We'll get a letter from the accountant that says that they've been doing their business returns for the 2-year or greater period. So there's a couple different ways we can fulfill those guidelines. It's not necessarily, Rick, more paperwork. It's just, as Kristen continues to say, and I love it, it's a different strategy. And that different strategy will have a different price tag to it, but it's not extraordinary. It's not, you're not talking 2 points difference, 6% to 8% or 7% to 9%. And again, it's dependent upon your credit scoring. If you're looking at a 700 credit score versus a 780 credit score, can you do a bank statement loan with a 640 credit? No, you can't.
Okay. So like just like if you have your own your W-2 employee, guard that credit score, because it's going to be key. And more so possibly than even if you were a W-2 employee, because you can pretty much with your pay stubs prove I've got an income. If you're got a really bad credit score, doesn't that then obviously show you may not even be a good business person or you've really extended? The credit score will
affect you, as Kristen will go into the DSCR loan, which is a fun loan as well, but the credit score will affect you with any loan, whether you're qualified mortgage, whether you're a non-qualified mortgage.
Okay.
Right. The difference between, go back to qualified for a minute, because I think it's that little teeny tiny thing that was in the Dodd-Frank Act that everybody discounted with qualified mortgage. Because what qualified mortgage really says is the investor is responsible for that mortgage for the life of its term.
Okay.
So in other words, if that file gets audited, if you're Fannie Freddie, you're a W-2 employee, you do a regular conventional qualified mortgage, the lender that is doing the origination of that loan is now responsible for that payment, for those payments, for the default or non-default of that mortgage for the life of it, 30-year, 15-year, 10-year AM, whatever it is you're doing on that. So if that file gets audited and that auditor sees something in that file 6 months, 6 years, 12 years down the road from the origination of that file, can they go back to that originating source, i.e. Nexa Mortgage, ABC, XYZ, whoever originated, and said, buy the paper back? It's not going to sit on Fannie and Freddie's books anymore. Yes, that happens all the time.
Okay.
Non-qualified, that doesn't take place because they are these strategic or unusual creative, I'm even going to say, mortgage products. And creative not in a bad sense.
Right.
Yeah.
Just creative that allows that individual to still get into real estate and experience the rate of return that real estate gives you.
And going to Nancy's point with the interest rate, the risk is greater to the investor because it's non-qualified. So hence you will take a little hit in the rate. But the long-term play is, I think the long-term play is the win-win for everybody.
Do the DSCR. Kristen, because
So your
that's a great loan.
DSCR, yeah, great program. It's an acronym for debt service coverage ratio. And this removes the person from qualifying because the property qualifies. So basically, all you're obtaining is, photo ID, assets. You do need a credit score. You got it, same thing with the non-qual. You need a typically 680 or better credit. And now the actual property is qualifying. So whatever that value is, there's actually two different valuations done to the property, one for value, one for rents. As long as those rents cover the payment, now you have a DSCR loan and you can build real estate wealth that way.
What's your minimum down, Kristen, on that?
Minimum down, Nance, I haven't seen, there are some 85s out there. Again, the risk is higher. You're going to take a hit in the rate. Typically,
So when you say 85, you're really saying 15%
15% down. Yeah.
Right.
Sorry,
So 10% down really doesn't exist on the DSCR?
It might, but you will, and are you a first-time investor? Are you, do you have 10 other properties? That plays into it as well. First-time investor, 10% down, 700 credit, not so much. 20% down, 10 rental properties, 780 credit, that would work. Depending on where you are in the country, sometimes this works great because values are out there, the rents cover it. Sometimes it doesn't. And when it doesn't necessarily mean you can't get the loan. Your risk again is higher, therefore you will pay for that risk in the interest rate.
So when we talk about cover it's not just the mortgage. Is it just like everything else? It's the HOAs, it's the, if you have them, it's the insurance, it's the taxes. So the rent has to cover all that so it cash flows, correct?
Correct. Yes.
Okay.
That is the ratio.
So this is definitely not your primary residence. This is a rental. This is an investment property tool, correct?
Correct.
And on the DSCR, right, there's prepayment penalties.
Typically, yes.
Typically, you're going to set it up with a 1 year. You could do a 3-2-1, right? First year, it's 3 year or it's 3% prepayment if you get out of it. Second year, it's 2%. Or you can do a full 3% if somebody's going to really go for the long play and stay in that property. Then do the 3-year prepayment penalty because, of course, the prepayment penalty is associated with rate. Is that
you and again, strategy. Sorry, my favorite word.
Yep.
But if I know I'm going to have this investment for only a year, you know what? I'll suck up and I ratio with the higher rate. Maybe I'll do that. If it doesn't ratio, then it may not make sense. Now I'm going to not pay it more in rate or cost. And I know I'm going to keep this for 10 years. I don't care. And I'm just going to. And the other thing that plays into pricing is, your impounds or escrow. Most of the DSCR files I've done, the lender wants the investor to pay the taxes and insurance in the total payment. They don't allow, typically, just globally, you're going to, because the investor wants to be protected that those taxes and insurance gets paid.
And are you finding then these are more for short term, meaning 10 years or less? They're not somebody who's trying to build a portfolio of investment properties that are going to become their retirement, or does this tool work for those as well? Sounds like you were talking a lot of short term elements.
I think it really just depends on the investor. I've had investors where they've, because the refi possibility is there as well. You could do a rate and term DSCR refi when, the market shifts or whatever the market is happening in the market. So most of the investors I deal with, it's a long-term play.
Okay.
I don't know. The neat thing about it is, Kristen, is that it not that it knocks out the hard money lender.
Yeah.
But it almost knocks out the hard money lender.
Almost.
Because,
Yeah.
right? Because you can use this DSCR loan, as you're saying, Rick, for short term if you're a fix and flip.
Okay.
Yeah.
Right. So you can be in that loan for 6 months
Right.
and you're paying seven and a quarter, 7.5. Go with your 1 year prepayment penalty, run your
Yeah.
numbers, see if it makes sense to get out of it. Is it cheaper than looking at that hard money lender at 10, 12, 14%? When you run your numbers, I think you're going to find that it is, because that hard money lender is still going to want you to have skin in the game, i.e. down payment.
Hmm.
Right? That 10% down, that 20% down.
Right.
The hard money lender, you miss a payment, that property becomes theirs.
There. Yeah.
The DSCR, that doesn't exist. So it's a cool product, and it's been out for how long, Kristen?
Yeah.
5 years?
Maybe 5 years.
Okay, so
Maybe.
it's really new. So if you haven't looked, that's obviously a key
Yeah.
way to get into real estate. Of course, what happens then 3 years down the road, and maybe the market turns on rents, and now you're upside down relative to cash flowing. I guess you just make up the difference, just like anything else that you're doing. That if you're losing money, right?
Yeah, I was
Yeah.
going to say there's never, that little ball of, what's going to happen in the future
Risk.
doesn't exist. So,
Mhm.
you do your investments with the same strategy,
Right.
your real estate investments, that you would do your financial investments, i.e. your 401k, your IRA, your stocks, your bond portfolio, etc. You have to be in the game to understand the game. So.
Mhm.
Right.
But
You recognize those risks when you jump into it too. And I think Nancy and I do we're, full disclosure kind of people, and, we're going to give you the what ifs and okay, well, if this happens, then there's this. And, and typically I'm not a what if in lifer,
No.
but when it comes to your investments, you got to play around a little bit and kind of just get that spreadsheet out and go, okay, well, if we do this, then we do this. And if we get this return, we're going to do this. So again, it just keeps it going. It goes back to the conversation of, what the goals are and what's going to make the most sense for anybody.
so if you're
I think, if you can make worst case palatable,
right.
Yeah.
anything from there is great.
Right. Well, but that's a discussion you would want to have, right, with either a Nancy or a Kristen or your mortgage professional, because I think so many people go in, probably less with investment properties, into the rose-colored glasses. I love this property. It's a business. It's a business. Will this cash flow? There's no point in doing it if it doesn't. From an investor standpoint, unless you see that it may not cash flow in the short term, but you see you're in an area that's appreciating or due to appreciate because of scarcity of land or whatever, and therefore you may make your money when you sell it, and maybe even be either break even or slightly upside down on the day to day or month to month. Obviously, it's harder to get the loan if that's the case, right? If it's up.
Well, it is, but real estate is. I mean, I think the reason Kristen and I love it so much and love the financing piece of it, and Kristen does both for that matter. She plays on both sides, which is kind of cool. And it is the strategy, but it's what the upside is, because it's finite.
Right.
There's only so much of it, and if you're lucky enough to play in it, I think you're lucky enough. So.
Yeah. So I've got these great strategies to if I want to have I'm self-employed, I want to buy a home for my family. How do I go through that? But but here again, I think Nancy and I've talked about this on multiple episodes. You can't go to a bank, right, and deal with these out of the box things. They're just not qualified for that. No. They're going to give you the box. They are literally the box.
They are the box.
They're the box.
I love that.
No, it goes back to my ice cream. Remember my ice cream?
Right.
They're vanilla and we're rainbow sherbet.
Right.
Yeah.
Exactly. So you need to find people who can handle both. The conventional, okay, I've got all my ducks in a row and a very in the box type of person, to somebody who I need a out of the box conventional or out of that conventional look so I can get the mortgage I want, because obviously you're essentially leveraging somebody else's money to make money. And as long as your interest rate is palatable, if that's a word, palatable, then that would be, beneficial. Now, are these typically variable rates, or are they fixed rate loans? Or does it matter? They're fixed.
We're not seeing a lot. This side note, I mean, we're just not. I'm not seeing.
The ARM product just doesn't play like
it doesn't make sense.
It really, the investor pool is not out there. They don't like the ARM product like it used to be 10, 15 years ago. You're not seeing a point and a half difference between a 5/1 ARM and a 30-year fixed. And I mean, they still play. The product is still out there. But for these non-QM loans, can you pick up interest only 30-year fixed?
Yes.
You can. And you pick up even, in fact, I was surprised, Kristen, because I've been starting to scratch the surface of 40-year AMs.
Yes.
Yeah, that I'm like,
just starting to scratch. Yep.
It's starting to scratch the surface again of these 40-year AMs. And again, it's working with the individual that knows the product, or that can think outside of that bank box, that credit union box.
Right. It's putting that puzzle together. We went from 100 pieces to 500 pieces to 1,000 pieces, and it's just putting the pieces of that puzzle together.
Yeah,
and
I like that.
And you need to make sure that and you may say 40 years, I'm not going to hold this place for 40 years, but that may help you cash flow it correct, so that it makes sense as an investment, because now instead of spending $3,000 a month, you might be at $2,200 or $2,500, right? So then, and therefore then it cash flows. But here again, that goes back to the S word, the strategy of how long do you think you're going to hold it? What is the property? What's it doing today as far as an investment? Does it have a rental agreement? So a lot of times, it's interesting, as a photographer, I run into people go, how did you take pictures with stuff that looks, in every room, it just looks terrible? Well, that's because basically the renter thinks that the owner's going to sell the home and they're going to be booted, and they want to make it not sell. So they're doing everything to not help it sell. What they may not understand is they're actually in the process, they could be in the process of helping keep their rental, property that they're in, because they're the cash flow for that property, and they're offering a bigger pool of buyers, correct?
That's right. That's exactly right.
So that makes...
Last but not least, I want to go in real quick to this income stream loan. It is, to go back to, it's not a non-QM loan. It is a qualified mortgage Fannie Freddie product. Fannie and Freddie have a loan that we always call it the 59.5 rule.
Okay.
If you're 59.5 or over, you tend to be a part of the populace that possibly is retiring, looking at retirement. And therefore, if you are, where's the income stream, right? If we go back to saying, Kristen, that, as we always say, the lender wants to know where the income stream is. The DSCR loan, the property gives it to you. The bank statement loan, the business gives it to you. The 59.5 rule, the asset gives it to the borrower, because say that they are retired. Now, let's say they've got X amount of dollars, whether that's 500,000, 750, a million, 2 million, whatever that may be, as long as that asset sits in a 401k or an IRA. And the reason it has to sit in one of those investments is because that's what's acceptable to the IRS. Wonderful IRS. And in turn, it's because that money goes in tax-free, it comes out taxed, right? Okay. And so in turn, you can build an income stream off of that asset. Say you've got $1 million in the asset. Say the person is buying $1 million home. Right? Say I or Kristen need 15,000 in an income stream to cover that debt that $1 million home, now, are they going to be $1 million mortgage? No, it's $1 million home. They're putting 20% down minimum. That's an $800,000 mortgage. So you're building the numbers backwards and figuring out what you have to have for an income stream to support, in this example, an $800,000 debt. Right. So let's say it's 15 grand.
Mm-hmm.
So we look at the asset and we say, okay, they've got $1 million in the asset. We're fine there, but we have one caveat that we have to satisfy, or one qualifying number that we have to satisfy. And that's it, that they have to have a 3-year continuance. So if you take 15,000 times 3 years, they have to have, what is that, roughly 350, 375?
That much money in that.
They have to have that much money in the asset pool. Now that you're good with that income stream, does the individual have to actually withdraw the 15,000 to show that they have the ability to withdraw it? Believe it or not, they don't. With Fannie Mae, Fannie says, provide the letter from the investor.
Mm-hmm.
Morgan Stanley, T. Rowe Price, Charles Schwab, whoever it is that you're doing your investing with, that says that Kristen, in this case, has the ability to withdraw the 15,000 a month, and in turn, that's what's used for the income stream to cover the debt on that loan. If you're in jumbo money, the story's a little different. You do have to deduct the money from your account. But it's a wonderful way where I just closed on 2 of these loans last week, that to still allow people that have given up their income stream because they've had the ability to retire. They've worked hard all their lives. They've saved their money. They have the asset pool. How do we show they've got the income stream for the repayment piece? So 59.5 rule is another cool way to go. You can also do an asset depletion, you guys, different story. You don't get the same results. You have to have some very high assets to do an asset depletion loan, where the income stream, if the income is in those 2 qualifying assets, again, 401k and IRA, you're good to go. If you've got just stocks and bonds, maybe you do want to look at an asset depletion versus the income stream.
So
what are we looking at on rates on that type of loan? Are they similar to?
Identical to,
yeah.
Identical to conforming.
Because it's a Fannie Mae, Freddie Mac product. It's qualifying mortgage versus a non-qualifying mortgage.
And these are primarily used for income properties, correct? Or not your primary?
No, primary residence.
Oh, for primary.
You can use the income stream, yes. Primary, secondary home, investment property. Yes, you can play with it because Fannie and Freddie do investment properties. But really, the DSCR is such a powerful loan in the investment world these days.
Yeah.
That I'd be calling Kristen, I'd be calling myself, and if you're looking at
run the numbers down,
I'd be looking at that DSCR loan, because again, the 59.5 is showing income stream.
Right.
Fannie and Freddie typically is showing income stream. The DSCR loan is just the opposite. There is no DTI on a DSCR loan because it's not income stream based.
No, it's the property.
It's the property.
Yeah.
Okay. So as long as the property,
a lot of cool options.
Yeah, that's really cool. That it's what I'm hearing though versus say 15 years ago is they're still doing it safely from a macroeconomic standpoint. That you're not the old liar loans aren't going to happen. That you still have to get the appraisal. And I don't know whether we talked about this before the show, Kristen, but it may have been part of the show about how you get the income, how you on that DSCR, how you determine whether it will finance and will cash flow.
Your appraiser, you have a valuation appraisal, and then you'll have a rental appraisal. There's 2 different reports that the appraiser will supply to the lender.
Okay.
And that report will dictate the quote unquote, allowable rents that we're going to use to cover the mortgage payment, whatever that looks like. then the question is, well, but no, my renter, I've already have a renter for the property and he's going to pay more money. Now it's another conversation with, okay, what was the down payment? What was the loan to value? What would the value come in at on the appraisal versus purchase price? Then now there's a few different things. You're going back to the underwriter and the lender, and you're having that conversation.
Okay, but it's just a couple of different appraisers. They're probably going to do comps if you don't already have a tenant in there, right? And so they'll look around and say what it rents for a 3-bedroom, 2-bath in this area going for, and then that number is what you start to reverse engineer. So you might say, okay, you can get $1,500 a month. That means that you can qualify for this. That means you need to put this much down payment in order for it to qualify, right?
Correct.
Okay,
Correct.
so
yeah, you're just playing with the numbers.
Yeah, and so you can either say, yeah, this is going to be fine, but most people will probably reverse engineer it, right? Based on what the rent starts at, and which is probably the smart way to go anyway, because otherwise.
Well, and that goes back to the more conversation. Before you go buy it, let's we have the ability through different lenders. Nancy and I can plug in an address in a lender portal and get an average market rents and average value just in the system. And let's see if it's going to make sense before we jump in there and make the offer and go through the whole process. So it's just, again, it's more conversation.
Just being able to understand where you want to go. You're almost in a real estate financial planning situation, I guess is the best way to put it. You're one piece of their portfolio, but you may be a small piece now, could be growing, but there are ways to get there without having to use your cash.
Exactly. And I think that's what's so great about Nancy and I, because you too, Rick. I mean, I don't think any of us would be in this business if we did not believe in real estate wealth and building real estate wealth.
Right.
That's the bottom line.
Yeah.
Long-term play, real estate is in my opinion always going to be a great way to build that wealth.
Well, and if you're going to buy some, let's just say IBM stock, there are ways to do it without your own cash, but it's really hard. And in essence, you want to use somebody else's money to build your wealth, and essentially that's what you're able to do with real estate. That you're maybe to take out a loan to go buy IBM stock may not be the best bet. But it may be difficult to get that if you go, well, what are you going to do with this? I'm going to go buy IBM stock, or I'm going to go buy the next startup. But this is a way to leverage somebody else's money to grow your wealth, right?
Right. Yep. So many different choices.
Well, this has been an awesome discussion this morning, because I learned something new, because I didn't know about some of these loan programs, because they're newer than when I was out looking. So obviously, if you have more questions or want to start the discussion and your strategy, you can reach out to Nancy at the number here on the screen. And thanks again for your insights. Or you can reach out to Kristen, especially if you're out in California. Nancy's here in Colorado. And as always, great to have you guys on, and look forward to seeing you. If you want more information about real estate and hear it from the pros, you can go to theproshow.com. Nancy's been on, I think, every one of our programs. And of course, we've done 3 or 4 of these with these ladies, and look forward to doing them again soon, because they bring valuable insights. And thanks again.